Hello everyone, welcome to Anu's Classroom. So this is also a special on request video from our community members in the Telegram channel. So I had asked you guys on any topics that you would like me to revise before the next upcoming examination for business environment. Okay, so the topics which were provided by you guys, I thought I will make a quick video for on those. So that is this video all about. So what are the topics I will be covering in this video? I'll write it down somewhere, okay, either on the thumbnail or in the description. Otherwise I will be saying one by one. Okay, so the first one we will take up is the Harrod-Domer model of economic growth. Okay, Harrod-Domer model of economic growth. So this is one of the theories of economic growth. So in our course, there are many theories of economic growth mentioned, right? So the most important ones are Harrod-Domer model. Okay, so this is this one. Okay, I'll write this HD model for short. Then we have Solo's model. Okay, Solo. I hope this is how it is pronounced. If it is wrong, do correct or apologies. Okay. Then we have the endogenous growth theory. Okay, endogenous growth theory, or also known as the new growth theory. So I will touch upon these three, but first let us start with the Harrod-Domer model of economic growth. So naturally this is applicable for the developing countries. It is a theory which suggests how developing countries or underdeveloped countries might achieve development, right? So according to this theory, what they are saying is that the growth rate in an economy, okay, the growth rate in an economy depends on the savings to income. Okay, savings to income rate. So this is one. Okay, so how much income your people are getting, and out of that income what percentage or what percentage they are able to save up. Okay, so that is one metric on which your economic growth will depend, and also on the capital to output ratio. Okay, so that is how much output can you get from a particular amount of capital that you invest in your economy. So these are the two rates or percentages on which the economic growth of a nation depends, is what Harrod-Domer model of economic growth is saying. Okay, that means investments. See, if you have income which is saved, then that becomes capital, right? Through banks or some other methods, it becomes capital. That is, investment increases. As savings increase, investment will increase, and therefore your output will also shoot up. That means investment increases the income. So income and productivity. When output shoots up, that means productivity is shooting up. If it is productive, then naturally income will also shoot up, is what Harrod-Domer model of economic growth says. So we can, write it as, or you can even describe it in a small pictorial way also. Okay, that Harrod-Domer model. How will we write? Here we will have what you can say. So how do we say this? Yeah, if your savings increase, it will increase investments. Okay, if investments are increased, that means capital is increased. If capital is increased, it means we have economic growth. Okay, we have economic growth or income. Income increases. If income increases, naturally savings increases. So this is one way in which you can pictorially represent this Harrod-Domer model. Okay, so the major assumption, so this is what was mainly asked actually out, that what are the major assumptions of the Harrod-Domer model. Okay, so in order for this model to work, what are the assumptions that Harrod and Domer proposed is what we are talking about, right? If this method, or if the economy has to function in this way, then one thing is that the economic growth is mainly determined by productivity and savings rate, right? So this thing, right, capital to output is nothing but your productivity, income to savings is nothing but your savings rate. So according to this model, one of the major assumption is that the economic growth of the economy in question is determined by the mainly determined by the productivity and savings rate. So that is one assumption. Okay, the next assumption is that if this has to happen, then all the able-bodied men and women, okay, employable people of the society are being fully utilized. There is no unemployment. Wherever, if there is an employable person, then that person is utilized as much as possible, is another assumption. Economy operates at full employment and makes use of all the available capital goods. There is no wastage of skilled labor or capital. Only then this will work. Otherwise, if there is leakage in the system, okay, either in terms of your capital or in terms of your skilled labor, then this cycle will not happen as smoothly. Correct? So that is another assumption. Second assumption, you can write that economy operates at full employment and all capital available is used up or is used. Okay, so that is the second assumption you can write. Then what else? It assumes that there is a constant return to scale, okay, for capital to output ratio and the propensity to save. So that means here savings and capital to output, these what you can say, they have a constant relationship. They go in proportion. As capital increases, as economic growth increases, that much savings also increases. Only then, otherwise what will happen if people start to hoard money or do not save, then this capital, again this investment will decrease. That will affect the capital. Or what you can say, even though savings is there, it is not utilized, it is not translated as investments. If it is just kept somewhere without transforming it into capital, also here the input to capital will reduce, then naturally this cycle will again break. Okay, so that is another assumption you can write on which this Harrod-Domer model works. Then what? Yeah, then you can say that the investment and the capital stock changes, they are treated as the net investment or the net the net investment is considered here. That is your gross investment minus the depreciation. As we all know, right, there we have total, we have gross, we have net, many different ways in which multiple economic terms are defined. Like profit also we have total profit, net profit, gross profit. Similarly, investment also we have, income we have. So over here in this Harrod-Domer model, we assume that the investment which we are talking about is the net investment. That is the total or the gross investment minus the depreciation. So these are the four assumptions of Harrod-Domer model. So I hope that part is clear. Anyway, since we are here, I will also explain the solo model of economic growth as well as the endogenous growth or the new growth theory. Okay. So in solo model of economic growth, it says that changes in the population growth rate, the rate of technological progress, savings rate, all these things will change the level of output. Okay. It is also called as the neoclassical growth theory. So in case question comes to you asking about neoclassical growth theory, okay, you have to write about the Solo's growth theory, Solo model of economic growth. According to this, the output, the level of output or productivity, if there has to be a change in productivity as in the level of output, then either there should be a change in the population growth rate or a change in the technological progress or savings. Okay, technological progress or savings. There should be a change in this population growth rate, rate of technological progress and savings rate changes for a change in the level of output. So that is the Solo model of economic growth or the neoclassical growth theory. Endogenous growth or the new growth theory. Endogenous means what? Look within yourself. Endogenous. Okay, so endogenous growth theory says that the growth of a nation can be generated by the endogenous factors of production, like the technological changes and all, which are happening within the nation or within that economy, rather than exogenous. Exogenous means outside. So exogenous factors rather than the exogenous factors. So it says that, or it suggests that the government who is responsible for that particular economy should focus on creation of human capital as well as attraction of foreign capital investment, technological process and all within that economy, and not just going for outside. So that is the Harrod-Domer model of economic growth and the other two major models of economic growth theory. Next we'll talk about the agricultural environment. Okay, so agricultural business environment or agribusiness environment is the next topic which came to me. So we will discuss about that now. So we all know how important agriculture is to the Indian economy, right? In the words of Mahatma Gandhi, he said that in order to find true India, you must go and look at the villages, right? So agriculture has been a part and parcel of our culture from time immemorial. We were always close to nature and close to earth. So what is agriculture? Agriculture is includes a lot of things, right? Farming, horticulture, and all those things are there as part of agriculture. So agricultural business or agribusiness, so what is that? So that is what you can say, finding out and using or utilizing the business potential of agriculture, large scale farming, and things like that. That is what encompasses the agriculture business or agribusiness. It is very essential, and it is because of this agribusiness that the agricultural sector has become attractive. Government is also giving more and more incentives to agricultural sector in order to what make it much more progressive. So I guess it was in 2018 or 2019, one of the economic reforms or the economic book, some booklet of government of India that I had the chance to read while I once had dreams of UPSC. Okay. So at that time there was a section about agriculture over there, and in that it was said that the Indian government at that time was focusing on not having a lot of people, doing agricultural business, but rather people who are innovative and takes the agricultural business to the next level using technology and innovative ideas. So rather than having many small farmers, what the government intends to do is to have big farmers, okay, who can take the agricultural business forward, because yes, food is essential. Without food we cannot live, but as you know, India is a service based economy. Most of the income that India gets is either through forex or exporting services out of the country, either IT sector or healthcare, Ayurveda, all these things, whatever it is. Even the religious stuff, like we have Isha and a lot of things like that also, which attracts foreigners, tourism. So basically it is a service that brings a lot of money. That is more than agriculture, right? I'm not saying that is the only breadwinner for India. No, don't take it like that. But compared to agriculture, it is these things, other things, service based stuff, which brings in more money, right? Compared to that is all I mean. So naturally, from time immemorial, we have had policies in place to help and support our farmers, starting from the domestic agricultural policies from 1947 onwards, marketing policies, then Essential Commodities Act, the Agricultural Produce Market Regulation, minimum support prices being given, and then finally coming to the economic farm reforms of 2020. That farm reforms of 2020, in case you guys get time, I would suggest you go and check, okay, because I don't know, it feels like an important topic to me. So you need to know the three acts in that: Farmers Produce Trade and Commerce Promotion and Facilitation Act, Farmers Empowerment and Protection Agreement on Price Assurance and Farm Services Act, Essential Commodities Amendment Act. These three acts which come under the Farm Reform 2020, you need to know, because it is something which has been in the headlines so much, right? So I don't know, I feel like there is always a chance for such a question to come up in your term and examination. It has come up in the past, so if not exactly the same question, some maybe it could come up as a short note or something like that. So just for the safety, be prepared for this farm reforms 2020. Okay, those three acts, what they mean in short, at least just have an idea, learn the act names at least, and have an idea about them before you go inside your examination hall. So the key players of this agribusiness or the agribusiness environment, there are the key players of this particular sector is the middlemen, mainly middlemen, many different types of middlemen. What are the various middlemen here? Merchant middlemen, okay, merchant middleman is there, agent middleman, okay, speculative middlemen, then we have processors, okay, the people who actually process these agricultural produce into much more value added things, processors, as well as facilitative middlemen. So who are the merchant middlemen? They are people like your wholesalers, your retailers, your village merchants, okay, those are the so mainly these wholesalers, retailers, and village merchants can be thought of as your merchant middlemen. Agent middlemen are your brokers. Okay, brokers and commission agents are your agent middlemen. Speculative middlemen are those who buy products at low prices when arrivals are sizable, like when the price is less they hoard stuff or they buy in bulk and they keep it with them and sell it in the off season when the prices are high. They take claim of the product as well as the risk which is associated with the aim to make profit. So the problem with so the speculative middlemen actually have quite a big risk to not just have a risk of whether or not you will get returns, whether the prices will increase, the demand will increase. That one part is there. The other risk is to store these products till such a point in time. So till then their money will be hanging. So that is speculative middlemen. Then we have processors, who are the ones who hire agents to buy for them from areas where production is high. Okay, and what you can say, and then bring on their business either on their own or on custom basis. So agents also may store these products and deal with it throughout the year or on a continuous basis. Then we have facilitative middlemen, who are facilitators in buying and selling, okay, while assisting the marketing process. They get income in the form of fees and service charge and all. So like for example, transporters who assist in the movement of the produce from say one market to the other, they are all facilitative middlemen. Auctioneers who help in the exchange of produce by putting the produce for public sale, those guys are called your facilitative middlemen. Okay, so I hope this much is clear to you. So agribusiness, it is the business sector encompassing farming and farming related commercial activities. So all the steps which are required to send any agricultural good to the market. So production, processing, distribution, anything and everything comes under the agribusiness sector. Okay, so it is a very important industry, especially in a country like India, where we are primarily agriculturalists, right? So a lot of, as I said, right, a lot of various aspects of agriculture is taken care of here. Animals, fruits, vegetables, fishes, a lot of things come under this business. So always these what you can say, environmental changes, droughts, floods, changing cycles, wind, rain, all these things. How do you fertilize the crops? How can you better utilize your fertilizers to get more output? How can you conserve water while ensuring your crops get enough water? Can we take up or can we cultivate any new hybrid varieties which can give us more output while the crops are still resilient to pests? Are there any new technology which we can use to process our goods so that they the productivity or the output from the same level of input can be improved? So all these things are challenges to their agricultural business sector. Then what else? So those are the major things I can think of in this agricultural environment. So let us move on to the next topic. So the last topic you guys suggested was the financial and fiscal sector reform. So let's get into it. So what are financial? What is a financial sector or financial service sector? It is the section of the economy, or it is that industrial sector, not industrial, right? It is that economic sector which is made up of all the firms and institutions which provide financial services. Ta-da! Not a surprise, right? Which provide financial services to commercial or retail businesses or customers, we should say, right? So this sector could have firms like let's say banks, your investment companies, insurance company. I'll just write LIC, okay, which is then could be real estate firms, banks, non-finance, not non-finance, right? Banking, small finance, investment banks, all these various types of banks, investors, investment companies, insurance company, all these things come under this financial sector. So then what else? Yeah, you need the reforms which have come up in the financial sector, right? So the regulation and supervision of this financial sector of India is carried out by RBI, the Reserve Bank of India, the banker to bank, the apex bank of India. That is the regulatory authority which regulates and supervises all the major part of this financial system or the financial sector. And it covers commercial banks, urban cooperative banks, any kind of financial institution, non-banking finance companies or NBFCs. All these people are, not people, all these firms, all these kind of businesses are supervised by this RBI. So there have been multiple regulations starting from the financial reforms of 1991. We have the first Narasimham Committee, the second Narasimham Committee, and its salient features. So all these things are, you need to know, at least, if not all the points which I mentioned, pick up a handful of points which you guys can easily remember from the textbook and memorize those. Okay, I know it is not possible to memorize all the points, but at least the salient features. of the Narasimhan committee reform, findings, and what changes did the that report bring up in the banking sector reforms. All those things, it is good that if you can learn and keep. Okay, so I'll just give a gist, I guess. So, what led to this 1991 financial sector reform? Not just 1991. So, 1991 was the first time this financial sector reform, the major financial sector reforms came into being, and then a lot of amendments had been done on that. One of the major turning points in this financial sector reform is the 1992 Harshad Mehta scam, which led to the setting up of SEBI and all the regulations on the stock markets, right? The quality of investment portfolio of banks actually deteriorated with this scam, and culture of non-recovery of assets developed in the public sector banks, which led to very severe problems of things like non-performing assets and all. So banks became less profitable. It was leading to a financial crisis. So financial sector reforms came into being. Some of the major things that happened with financial sector reforms include reduction in the statutory liquidity ratio, cash reserve ratio, nationalization of banks, end of administered interest rate regimes, then what else? Such things, competitive financial system development, allowing foreign banks to set up and operate in India using through branches or through wholly owned subsidiaries of foreign banks or subsidiaries within aggregate foreign investment or FDIs up to a maximum of 74% of the paid up capital. Then what can we do for the non-performing assets or income recognition? All those things came into started being considered one by one, and so that is in short about the financial sector reforms. So at least a few points I you will have to memorize. There is no way out other than that. Okay. Then what is fiscal sector reform? So financial was dealing with all the money, banks and things. Now what is fiscal? Fiscal deals with the taxation and things like that. Okay, so the changes to the levels of taxation and government spending is what comes under your fiscal sector reform. So when you think of fiscal, think tax, government spending. When you read the word financial, think banks. Okay, so to simulate the growth, definitely any government thrives through taxes. If we guys don't pay up taxes, not just us, all of us, right, the entire Indian population, if we don't pay our taxes properly, then there is not going to be money with the government. You might ask ourselves, according to how the government spends, that what is the point in me giving money to the government as tax? They'll just use it for their own purposes, right? So that is something which we all have varied opinions on, right? I'm not getting into that, but the thing is, government needs money to provide public services, and where does that money come from tax. So if tax is lowered, and always it is what you can say, it is happy for us that if the tax is less, right? If we don't have to pay tax altogether, or if we don't have to pay that much of a tax, then it is a happy thing for us. At the same time, even with a lesser amount of tax being paid, if the progress is enormous, if the spending is increased, then is also good. It is happy for us. So that is how growth is stimulated. To stimulate growth, lowering taxes, increase spending, to all these things, fiscal reforms come into picture. Again, fiscal reforms also, the major fiscal reform again started from this 1991. Before that also there were, but the major turning points were from 1991 onwards. So the government of the Indian government manages this tax and public expenditure and all those things, and promotes the growth of economy through this fiscal policies. So GST is important when it comes to fiscal sector reforms. That is one of the major fiscal reforms which has happened in recent times. So it is good if you have an overall idea about that. Again, just like how I said about financial policy, it is good if you can at least grasp a few points, memorize them and go. There is no other way out here. It would be good. Okay, so then what else? So if a question gets asked about policy, you can say that this is what fiscal policy is, right? Ensuring economic growth, price stability, reduction in inequality, all those things are the objectives. And then what? How do we meet objectives like high economic growth or price stability or reduction in inequality? Through consumption control, raising the rate of investment, through taxation changes, infrastructure development, exemption from taxes to vulnerable classes, heavy taxation on luxury goods, discouraging unearned income. So that is one of the reasons why there was a huge push towards having bank accounts and promoting all transactions being done through banks. Linking of your PAN to bank accounts or Aadhaar to PAN and everything is happening because the government wants to discourage unearned incomes and tax defaults and all those things. So the main three components to the fiscal policy of India are government receipts, government expenditure, and public debt. So fiscal policy deals with taxation and government expenditure. Please keep that in mind. So what are government receipts? Government receipts could be revenue receipts like direct tax or indirect tax or fees, licenses, permits, fines, penalties, all those things, or capital receipts like loan recovery, disinvestment, borrowing, other liabilities, all those things. Okay. So that was in short about the fiscal sector reform. So these were the topics which you guys told me when I asked you guys. So that is it. This is the video. A strong, humble recommendation actually. Please don't restrict yourself to just this video. I had done a detailed video covering almost all the important topics there is as a quick revision video earlier. It is already available in the channel in the term and examination playlist. Do go check that out. And also I had discussed all the previous question papers also in another video. Consider looking at that also. I'm saying this so that you guys have a good idea about the important topics that you have to cover at least to get passing marks. Okay, I hope that all of you are able to write your exams very well, that you find your exams easy. All the very best, and until I see you in the next video, bye bye and take care.